Hey everyone. For today's video, I'm doing chapter 4 of Trading Price Action Trends. It's bar basics, signal bars, entry bars, setups, and candle patterns. It's a pretty short chapter. It's introductory, so it's only 11 slides. So we'll get through it pretty quickly, and then it'll set up the content for chapter 5, which is on reversal bars. So in this video, I'll be talking about how Al names the bars in sequence of an entry, why it matters that we name them, some details of signal bars in brief, because the next few chapters are all about signal bars, and then Al's recommendations. Al starts the chapter off by talking about what a setup is in general, and a setup is a chart pattern that's made up of a single bar or many bars that can lead to a profitable trade. So all the patterns that we see, we're using those bars to determine what can potentially happen next. And so a setup is something that can lead to a profitable trade. And when that setup is in the direction of the current trend or the recent trend, it's a with trend setup. And when it's against the recent trend, it's a counter trend setup. And within a setup, the actual bar that can lead to a profitable trade is called the setup bar. And so we're going to be talking about that on the next slide, that when you have a bar that can lead to that move, that's the actual bar that determines if you're going to enter or stay out. So every bar on the chart, on the 5-minute chart, every one of those 81 bars is a potential setup bar because it can potentially lead to a strong move one direction or the other. And when you have a bar, Al says that you have to assume that there are traders on all sides of the bar. So at the high of the bar, you'll have stop order bulls buying one tick above, betting that the breakout above the bar will succeed and lead to a strong move. But at the same time, you also have limit order bears who are selling the high of the bar, betting that it's a 1-bar trading range and that the breakout will fail and will reverse down. So you have bulls looking to buy above and you have bears looking to sell at the high. And then at the bottom of the bar, you have limit bulls who are buying the low of the bar, betting that the breakout below the bar will fail and that will reverse up. And you also have stop order bears who are betting that the breakout will succeed to the downside, and they're looking to sell one tick below. And so whichever one of these situations we're in as traders, Al is saying you have to assume that there's someone doing the exact opposite of you at every moment. Whatever you decide to do, there's someone doing the opposite. And he's mentioned that many times throughout the book, to never be too certain, because there's a good reason to buy here and there's also a good reason to sell here. And same with at the top of the bar. And so our goal as traders is to find areas where there's going to be an imbalance at the extreme of the bar. So when is it going to be clear that there are going to be more buyers above than sellers? And that's where we have to buy. And when is it going to be clear that there are more sellers below the bar and there won't be that many buyers? And that's what we want to sell. We want to find where one side at the extreme is going to overwhelm the other side. And the example Al gives is buying a pullback in a bull trend. So we have a strong rally here. We have a first break below the moving average and a second entry buy. So this is the setup bar. The setup is a wedge bull flag or a double bottom bull flag. That's the entire setup in a bull trend, which can lead to higher prices. This bar itself is the setup bar. It's the bar where traders are going to look for an imbalance. Are there going to be more buyers above this bar or sellers? Based on the context and the location, it's a really good signal bar closing near its high, and it's a wedge bull flag and a double bottom bull flag. There are probably going to be many more buyers above than sellers. And so that's an area of imbalance. And it's a reasonable area to buy. Now, once that setup bar triggers, so when the next bar goes above that bar and where traders are trying to exploit the imbalance, as soon as it goes above that bar and the setup bar triggers, it becomes a signal bar. So now that the bar has triggered, it's a signal bar. And the bar that triggers the buy is called the entry bar. So this is now the signal bar, and this is the entry bar. The bar after the entry bar is the follow-through bar. And it's always better to have follow-through in the direction of your trade with a strong trend bar. So here, this is the biggest bar of the three. So the market's accelerating up, and that's an extremely good follow-through bar, closing above the moving average. The entire bar is above the moving average. And that's an important sign to look for, that after the entry, there is follow-through in your direction. And Al mentions in the book that sometimes the follow-through bar won't come directly after the entry bar. Sometimes it'll go sideways for a couple bars first. But as long as you're in the trade, you want to see some kind of follow-through in your direction. So it may not come right away, but typically you'd like to see it come after the entry bar because it shows urgency. So why does this matter? Why does the signal bar, entry bar, and follow through bar matter in terms of why we're naming them and identifying them? And an underlying theme for all of Al's work, and what makes him different than many other traders, is that he believes that every bar matters. There's no noise, and that every bar is telling you part of the story. And if you ignore one bar and call it noise, then you're going to miss an important piece of the puzzle. And within that concept of every bar matters, the details of every bar matter. So it's not just that it's a green bar or a red bar. It's that it's a green bar, and where is it closing? Is it closing near its high? Is it closing near its midpoint? Is it a doji bar? Is it closing above the open or below the open? All these little details matter to him, and he says that they matter in your decision-making process. And so if they matter for decision-making, that means they'll matter for active management. And he talks about that in the next chapter, where if you're buying above a bull reversal bar in a strong bear trend, you want to see immediate follow-through. And if the entry bar is a small doji bar after the signal in a reversal, it's showing that there's not much urgency. It's showing that we're pausing. And so he actually recommends that if the context isn't amazing and you get a small doji entry bar, then maybe it's better to exit break even right at the market and not wait to see how the trade develops. And so the entry bar and all these bars, knowing what they look like and how they work together with each other, is going to be important for how we manage trades depending on the context. And then finally, identification of mistakes. I know for me, there are a lot of times where I'll buy below the moving average and the entry bar and follow through bar won't break above the moving average. They'll stay below it. And if you can notice that's your biggest problem, that when the follow through bar doesn't break above the moving average, then it's forming a bear flag. So here, for example, the entry bar broke above the moving average. The follow through bar was a strong trend bar in the direction of the trade. But what if the entry bar was a doji and closed below the moving average, and the follow-through bar was a doji and closed below the moving average? Then we have a potential situation where we have a double top bear flag and we might be going down for one more leg. So to be able to go back in your trades and say, I struggle with getting out early because I'm not reading the follow-through bar well, or I'm not reading the entry bar well, I think it helps to make adjustments based on where you find you struggle most. So Al briefly talks about some signal bar details. It's a pretty brief overview because he talks about this a lot in the next few chapters. But the main message of this chapter is that as the strength of the trend increases, the importance of the with trend signal bar decreases. So if you have a really strong bull trend, then the bull signal bars become much less important. You don't need to find a perfect bull signal bar if you're trading with trend. But if the trend is really strong, then the importance of the counter trend signal bar becomes increasingly important. So with really strong trends, in order to have a reversal of that trend, you need to have a really good signal bar. So with trend, you can be less picky about the signal bar, but counter trend, you have to be extremely picky about the signal bar. So Al says that the strongest trends often have bad signal bars, and you can enter for almost any reason in the strongest trends. And he justifies this by saying that strong trends need to have bad signal bars, because if they were really strong, it would be obvious what's happening next, and the market would just make a quick move in that direction, and it'd be a scalp and not a swing. But because the signal bars in a really strong bull trend are often not very good, it keeps market participants guessing, and they have to keep buying in small sizes and small pieces, and they keep buying all day, and that trend ends up lasting all day. So strongest trends often have less clarity, but it's often less important to have clarity in a strong trend. You can just buy for any reason if you use the correct stop. And then he says that the strongest reversals have very strong signal bars, and the probabilities of reversals are lower. So it's very important to have a close to perfect signal bar, and you have to be a lot more picky when you're trading counter trend because the probabilities are lower. And so you want everything working in your favor. And for the context to be supportive of a reversal, Al's definition is to break above a strong bear trend line and get above the moving average, or break strongly above the trend line and above the moving average, and then test the extreme. So here we have a break above this down trend line, the bear trend line, strong break above the moving average, and then we test the extreme. And then down here on bar 73, it's a second entry buy after an overshoot of the bear trend channel line of the test. So this is the test of the extreme, and we overshoot the trend channel line and get a second entry buy. Now, this is happening late in the day, but this is the kind of signal bar and the kind of context where a trader should try to buy a reversal and not above 31 or above 24 or above 18, because those are all in a tight bear channel. So his criteria for buying counter trend is that it has to break the trend line, test the extreme, and then give you a really good signal bar. And I spent a lot of time in Al's room, and he often says that you shouldn't be too rigid. Like if it looks like it, it's probably going to act like it. But with counter trend entries, he is really rigid. And so he often does buy before the trend line break, but he'll often say that he needs it to look perfect, or he didn't take it because it had a 2-tick tail or 3-tick tail. So if you're going to buy counter trend, even Al at his level after 30 years is still extremely picky with what the signal bar looks like. And his recommendations for in this chapter are that beginners should only enter when the setup bar is with trend. And so in a bear trend, only look to sell, and only sell below bear bars that are closing on their low. So for example, here in this bear trend, only look to sell, which is something I struggle with. Only look to sell, and only sell below bear bars closing on their lows. Pretty straightforward here because there's so many bear bars closing on their lows. That's just a strong and tight bear channel. But here, 2-bar breakout, bear bar closing on its low on bar 4, sell below that. Bar 7, acceleration down, sell below that. And then we have a pullback here on bar 10, and then bar 11 closes near its low. If you don't sell below that, you can sell below 12, which is a low one sell. We have a breakout pullback, 19 close on its low, you can sell below that. So, and these aren't necessarily the best entries, but if you're going to sell, try to wait for a signal bar that closes on its low and only look to sell. And for in a bull trend, only look to buy and only buy above bull bars closing on their highs. So here, for example, we have a breakout. You can buy above, if you want to buy, you can buy above these bull bars closing near their highs and use the correct stop. We have a pullback and a signal bar closing on its high. This bar closing near its high. Pull back here to the moving average and a bull bar closing near its high. Again, these may not be the best setups to take, and it depends on what the stop is, but in general, Al's recommendation is if the market's going up and it's in a bull trend, only buy and look for signal bars that are closing on or near their highs. And that will significantly increase the probability for a beginner. And when Al says beginner, I feel like I've been put back in that box. I don't think it's just beginners. I think if you're struggling, you should go back to basics. And so it's for beginners because it's a good starting point, but also if you've gone astray a little bit and you lost your footing or you're not feeling as confident, I think these rules apply to even experienced traders who just need to get back to the core principles of good trading. So yeah, I hope that's helpful, and I'll post chapter 5 shortly.